What is higher high, higher low, lower high, and lower low strategy? In any strategy there must be some basis on which it should work. When creating your own strategy, you also need such a foundation, for example, some inefficiency of the market, or its regularity, and on this basis, you can build points for entry, exit and correction of the position. First of all, let's remember the classical definition of a trend. An uptrend is a series of successively rising highs and rising lows. That is, each high, H, is higher than the previous one, and each low, L, is higher than the previous one. The opposite is true with a downtrend. In a downtrend, the highs consecutively decline and the lows also decline. Perhaps you have already guessed what kind of structure we will be looking for on the chart. That is, what is the very first sign that will allow us to understand when we should pay attention to the market and wait for a possible entry point? Let's assume that we have an uptrend. We have point H, followed by a correction at point L. This is followed by a higher high, labeled in this strategy as HH, higher high. Then, as soon as we see a break in the trend structure, that is, LL, lower low, we get ready to look for a sell point. Similarly, with a downtrend. First, we determine the low L, then the high on the correction H, the lower low LL and finally the higher high HH. This means that the structure of the downtrend is broken. We pay attention to this situation and wait for a possible entry point to buy. Let's start by considering a sell entry. We enter on the pullback to point H. This structure works because there are big players in the market, and big players need liquidity. That is, in order to make a large sale they need a large number of buy orders to dump the currency. The zone between H and HH is a zone of high liquidity. Accordingly, there are many people willing to buy here, as they hope for the continuation of the uptrend. You can enter with a pending order, in which case the sequence is as follows. We wait for the formation of the LL point, trend break. Then set sell limit at level H. As in the case of selling, in the reverse pattern we have a zone of increased liquidity between points L and LL. There are many people who want to sell here, those who hope for the continuation of the downtrend. Someone bought too early, someone panics and losses positions, also many people may have stop losses in this zone. Accordingly, it is a good opportunity for a big player to buy, and we enter the market together with it. We are waiting for the formation of the HH point. Then set buy limit at the level of L. Risk management. We place the stop loss behind the extreme point of the high liquidity zone. HH, in case of sells, LL, in case of buys. Stop loss is placed at the points where we can say for sure that we are wrong. We have two targets. For sells, the first target is at the L level, the second at LL. For buying, on the contrary, we take the first profit from H, the second from HH. If the distance between the target 1 and 2 is too small, it makes sense to take only the first target. In other cases, you can take the average value between the 2 points to set take profit. Summary. Try not to look for setups in price chaos that are not there. Trade only the right setups with a good ratio of profit to risk. This method I find great for reversal of supply and demand zones. Also, this strategy can be used in combination with other strategies. Kindly like, share, and subscribe us for more.